We'll start, if I can have your attention. Thank you for joining us today for this business hour. We're going to be discussing death, taxes, and retirement plans, but not quite in that order. I'm Roger Shoemaker, chair of our estate planning and probate practice group. Joining me on the panel today are Tony Pilsner, a member of our executive compensation and governance practice group. Tony is based in our Detroit office. Mike Riley is a member of our estate planning group, as well as executive compensation and governance practice group. John Wirtschafter, he's sitting in for Dale Vlasic. Dale was called to Las Vegas for an important conference, but John is equally capable. He just didn't get the call to Las Vegas. He's a member of the executive compensation and governance practice group as well. We'll be happy to answer questions from you during the program. For those of you here in the Cleveland audience, you have a card that you can hold up, and one of our staff members will deliver that to us. For our participants outside of the Cleveland area, you are watching on the live webcast from our new McDonald Hopkins website. You are welcome to submit your questions by clicking on the green chat icon on the right side of your monitor or mobile device. If you submitted questions in advance, we plan to cover those near the end or by follow-up email. The two questions we had are quite not on topic, but they deserve answers. We planned this with an eye to the election outcome, and it fell under my least likely scenario. I was going to put this together on Tuesday, and I said, oh, let me wait and see what happens with the Senate and House elections. I stayed up to see. I finally gave up, but I did find out before morning what the results were. It's kind of hard to tell, but with unified government, things should proceed a little more, even less contentiously than regular. President-elect Trump campaigned on tax cuts, corporate and personal, as well as the repeal of the estate tax. One colleague thought repeal would be sacrificed in the legislative process. Others think that it will be part of broader tax reforms as they move through that process early next year. We may see a capital gains tax accompanying that repeal of the estate tax. In all likelihood, the step up in basis or fresh start basis will likely no longer be available because the idea was it was a loophole, so to speak. It was a benefit of having paid estate tax. If nobody is paying estate tax, they shouldn't be able to avoid the capital gains tax. Plus, the legislative process is very convoluted. There's the 60-day or 60-vote rule. There's budget reconciliation that can permit less than a 60-vote majority. And then there's something called the Byrd Rule that requires the lapse of tax reductions if there's not an equivalent offset of revenue. And that runs for 10 years, which was what happened to us in the 2010-2011 timeframe, where we had no estate tax and it was supposed to revert to the $1 million level. The other thing to keep in mind, especially most everybody here today is an advisor, there's only 0.2% of the population who have estates larger than the exemptions. So that's an awful lot of us going after the same people who are looking for true tax benefits. But there's a lot of work to do, no matter what happens. Because all of the other problems that are associated with transfer of wealth will continue. It's just one component may be a lot less important. So that's the introduction and comment on the taxes. If we have questions, we'll try to respond to those later. Let's move into the main part of the program. It seems increasingly that when we meet with estate planning clients, a predominant asset is qualified plan, pre-tax money. You all are a part of having helped create that wealth and extend and grow it. So you're doing a good job. The heavy concentration of the pre-tax wealth presents some complexities in the planning for life and death time transfer, and that's the real focus today. In the first half, we'll focus on ways that clients can continue to grow that pot of pre-tax money, and in the second portion, we'll focus on the disposition of that money, both during lifetime and at death. So, Tony, what can you tell us about the opportunities that are available?
Well, thanks, Roger. And as you probably know, using an employer's qualified retirement plan, particularly a 401k plan, is still a great tax benefit. It is still probably the best, in some cases, the only avenue a high net worth individual especially will have to put money away on a pre-tax basis. They're precluded from deductible IRAs. They're probably precluded from Roth IRAs. So working through the employer's qualified plan gives them the opportunity to put money away on a tax-preferred basis. The other benefit that sometimes gets lost, it's not really wealth creation related, but keeping in mind that as long as the money stays in the qualified plan, it's pretty much safe from everybody except the IRS and a former spouse. It's protected from creditors, and it's got that other protection as long as it stays in the plan. So keeping the money in the plan has that advantage as well. Now, the IRS does limit the total amount of money that someone can have put aside in a qualified plan, either of their own money or their employer's contributions. And the limits, are fairly high to some degree. They're based on compensation, and the most compensation that can be taken into account in 2016 is $265,000. For 2017, it'll be $270,000. So that gives us some room to work, but in some cases, not enough. The total amount of employer and employee contributions that can be put into a defined contribution plan is $53,000 in 16, and it'll be $54,000 in 2017. So there's some opportunity to accumulate some wealth there. There's also limits on what the maximum amount of a defined benefit plan annuity benefit can be accumulated in any year, and that's $210,000 in 2016, $215,000 in 2017. Keeping in mind that's well above the guaranteed level that the PBGC will be protecting. So you can put that into a plan, but it's not protected above the PBGC level. With respect to individuals putting away their own money, employee contributions to a 401k plan is really the most effective way to save money on a tax-preferred basis. It's certainly higher limits and greater opportunity than with IRAs. IRAs have income limits, and they're much lower limits. So someone can put up to $18,000 of their own money into their employer's 401k plan every year as a general rule. Their limit in an IRA would be $5,500, so it's almost 3 times that limit. Now, to the extent the individual is highly compensated, which means in most cases they received $120,000 of compensation from their employer in the prior year, they could be limited, that $18,000 could be limited because of non-discrimination rules that say highly compensated individuals can't put in a disproportionately higher percentage of money into the plan than non-highlies. So to the extent that someone works in a workplace where there's a lot of non-highly compensated individuals who don't contribute at all or contribute very little, their ability to put that $18,000 away could be reduced. Now, employers can mitigate that by designing the plan to be a safe harbor plan. Safe harbor plans require the employer to commit to certain minimum amounts of contributions, employer contributions, for at least the non-highlies, either 3% of their compensation or a minimum matching contribution that works out to about 4% if they contribute 5% of their own money. It's an increased cost for the employer, but it eliminates the administrative work of testing the plan every year, and it allows all their highly compensated individuals to put the full $18,000 away, regardless of what the non-highly compensated individuals are doing. So to the extent that it's a closely held company or it's a company that wants to benefit their highly compensated employees, that cost-benefit analysis might end up being, it's better for us to be a safe harbor plan, then we don't have to worry about anything, and our highly compensated people can put away the full $18,000 every year. So that's one way to make sure that they can get the most out of that. Another piece that's really beneficial is the catch-up contribution. If you're 50, at least 50 at the end of the year, you can put an additional $6,000 away in 2017, 16 and 2017. It's not increasing next year. That $6,000 is special in that it's not subject to the non-discrimination rules, so they can always put that away. And it's not subject to that limit of $53,000 or $54,000 on total employer and employee contributions. So that $6,000 can always go in. So they want to, you want to take advantage of that. You want to make sure you get that money in there because that you can always do. Another part of the flexibility that an employer plan can provide is they can allow someone to make those contributions on a Roth basis as well. They can let people decide if they want to make their contributions pre-tax or as Roth contributions. And again, unlike a Roth IRA, which has lower limits and also phases out at income levels, anywhere from $132,000 to $194,000, depending if you're filing a single return or a joint return. Your income doesn't matter. You can always make Roth contributions to an employer's 401k plan as long as the plan allows them. And you can make up to $18,000, plus the $6,000 in catch-up in Roth, if that's what your financial planning shows you would be better for you. Now, as a general rule, making Roth contributions presumes that your tax rate now is lower than what you expect it to be in retirement. Because Roth contributions are taxed when you make them, but then the contributions and the earnings come out without any tax at all, as long as you take them out after they've been in the plan for 5 years and you're over 59 and a half. So, but it only makes sense if you can project that tax you pay now is less than the tax you'll pay if you had paid tax on all the contributions and the earnings after retirement. Well, given that we've been promised the largest tax cuts since the Reagan era, we may have to look at that again. We may have to say, the TAP rate is projected to be or proposed to be 33% as opposed to 39.6. That may be enough of a differential. And if you're thinking by the time I retire, tax rates could go up again because we'll have administration change, we'll have budgeting issues, and with the federal government that they might increase the tax rates. We may want to do Roth contributions in the years the tax rates are low. The other piece of that are Roth conversions. You have the ability to take pre-tax money in an IRA or in a 401k plan if your employer plan allows it, and convert it to a Roth. You pay all the taxes now, and it continues on as a Roth account. So the money will all come out tax-free in the future. So we have some different planning opportunities depending on how these tax cuts come to pass. But we probably want to take a new look at whether or not Roth makes sense. As I said, for high earners, because of the tax brackets, it didn't always make sense. We may want to look at that now, considering we may have lower tax rates that may not last after we have an administration change. So another thing that we want to look at, as I said, and if your plan doesn't allow for an in-plan rollover, meaning you take your pre-tax money, pay the taxes on it, it becomes a Roth account within your 401k plan. If your plan allows you to take an in-service distribution, you can take that money out, roll it over into an IRA, a Roth IRA outside of the plan, do the same thing. So there's a number of opportunities, but you still have to run the numbers and figure out, am I going to guess that tax rates will be lower or higher when I retire, or I'll be in a higher bracket than I am now? As I said, we'll have once we see what the tax changes are going to be, we may have to do some new analysis of how that works out. Now, there's a reference in the Trump tax plan to eliminating limits on contributions to retirement plans. I don't see that as coming up quickly. It's certainly not in the 100-day plan unless it's going to be part of the tax reductions, but I think they may have some issues with the funding of those tax cuts such that lifting all the limits on contributions to retirement plans might not fit in that first wave of tax change. But we'll keep an eye out for it. But as it stands right now, proposals to reduce the limits, proposals to tax accumulations have generally come from the Democrats. And since they're not in power, we're not expecting limitations to come into play. If anything, we may have greater opportunities in the near term, but not so much reduced opportunities. So as it stands right now, we're kind of working on a status quo basis, and still we're going to have to see how the tax rates come into play. But as a general rule, there's still great opportunities to put money away on a pre-tax basis using an employer's 401k plan.
Good. Just to fill in a little details on the Trump plan, there'd be three rates, 12, 25, and 33%. replacing the 7 rates, or 7 rates that are in the code right now. Alternate minimum tax would be repealed. The net investment income tax, I think, is on the chopping block. That was implemented to supplement the funding for the Affordable Care Act. So there'd be some significant reductions, but again, tempered by revenue needs, because of the things he's talked about will cost a lot of money. We may get a lot of growth in tax from the tax, or revenue from the tax on the growth, but so. John, what options are available if someone wants to do more than those limits?
Oh, that's a good question. I mean, looking at the tax rates and what we expect, this might be a good year to take some extra deductions. So we expect that you're going to have a lot of conversations and you're going to be looking at this for yourself and your clients, and we're going to be doing the same toward the end of this year of ways that you can bump up those contributions that Tony just discussed. And that might be because you can't get into the 401k plan because of the discrimination testing, or because it's too expensive to make as a profit sharing contribution because of the cost of providing what you'd have to provide to all the other employees. As you probably know, when you make a general standard profit sharing contribution, it gets allocated pro rata based on your compensation. So if you make $200,000 and you have an employee that makes $50,000 and you make a 5% contribution, you're making a 5% for everybody. That's just sometimes too expensive. So we look at other alternatives, and there's a few that we use pretty routinely, and that you're going to want to look at as well this year if you aren't familiar with them. And I'm guessing most of you are, but let's just go through them anyway. So the first one is just using Social Security integration. Companies make contributions for their employees for the Social Security tax. And as you know, that tops out at the wage base, which is $118,200, I believe. Next year it's going up to $127,500. So any compensation that is earned above that level, neither the employee nor the employer are making contributions, and by the way, you're not going to get any Social Security benefit for that either. So what the code does allow you to do is to put into your profit sharing formula an integration formula that allows you to make a kicker, a little bit extra contribution, up to 5.7% of compensation above that level. And there's a lot of ways to write that provision so you can kind of decide what makes sense for you. But that's just one way. But that's not a huge kicker, and that's not going to really change the game much. So what else can we do? Well, as you may know, every 401k plan is basically a profit sharing plan. Not every company makes profit sharing contributions, but everyone is a profit sharing plan. We utilize something called new comparability a lot of times for our clients. And what that allows you to do, so we talked about how a standard profit sharing contribution is allocated, pro rata by compensation. And that's looking at the contribution for each person and making sure that basically it's the same or it's non-discriminatory. But you are allowed to test it instead of looking at the contribution by looking at the benefit. So I can calculate what that benefit will be when you hit your retirement age and show that for each of the participants that I'm contributing to, and use that to show that, well, it's really not discriminatory. Now where that works out really well is if I'm in the same plan as my secretary and my assistant, and they're both in their 30s, and I'm in my 40s.
Yeah, we'll go with that.
Okay, the point is, I have fewer years to accumulate earnings on whatever I contribute for me to my normal retirement age. And so I would need to make a larger contribution now because it's not going to continue to accrue those earnings. So that's a great way. And now there's all sorts of very complicated discrimination testing that needs to be done in order to make that work. And we use actuaries, and there's a ton of them out there, but we use actuaries to help us justify exactly how to design the plan. But the beauty of it is it's incredibly flexible in the sense that you can design it to target a specific group of your employees or executives. It might be 2 of the 3 key owners and a small layer of the junior management. It may be, I don't want to do anything for our salespeople because they're, I just want to motivate them by commissions, but I want to do it for all of our, all of our engineering people because I need them to be motivated. You can design these things in 100 different ways, but if that's for me, please take a message. you can do these in 100 different ways, and it's really based on the objectives of the company as to which way you go. Now, the beauty of any of these things is that we can implement them before the end of this year and take the deduction this year and not fund them until you file your taxes next year. So if you extend your tax date, you don't have to fund them until, till September or whenever it is that you ultimately extend it to. So, but you get the deduction this year. So it's really good. Now, that would allow quite often for a company or for you to get up to the full defined contribution limit that Tony talked about, the $53, soon to be $54,000 limit, plus the catch-up if you're over 50. So that would allow you to do that with a relatively efficient contribution for the rest of your employees. But let's say that's not enough. Let's say you're having a great year, or your client's having a great year, and you recognize that this may be the highest tax rate you're going to have for a number of years, and you really want to get more into the plans than even that. Then we look at defined benefit plans, and don't get nervous. I know many of you have dealt with pension plans over the years, and you read about the actuarial problems that they have had with very low interest rates, high mortality or low mortality now, and not a robust economic market. We tend to use what's called cash balance plans. Many of you are familiar with the cash balance plan. It looks, tastes, and smells like a 401k plan, a profit sharing plan. People are actually getting nominal contributions and they have an account balance, quote unquote. You're just funding it like a defined benefit plan, and it has the defined benefit limits. So instead of being stuck at that $54,000 next year, you can go up to $215,000 above that. It's really quite powerful. Now, there are all sorts of discrimination tests that you have to run in order to be able to put in a defined benefit plan. But again, using an actuary, we found that they can be designed very efficiently to provide for very robust benefits. So if you have someone that's 50 or 55, they may be able to put in another $100,000 or $150,000 above and beyond the defined contribution limit this year. And again, not have to fund it until next year. So it's really a winning situation. Now, defined benefit plans are complicated. You have to hire actuaries. You have to, if you have employees, you have to file with the PBGC and pay PBGC premiums. You have to fund them in ways that you don't necessarily have to fund a profit sharing plan, because a profit sharing plan is just that. You elect at the end of the year what you want to do, and the plan tells you how to allocate it, whereas the defined benefit plan, you don't have quite that much flexibility. It is a defined benefit that you're funding towards. But we've come up with all sorts of techniques to help alleviate some of those concerns, and they may make sense for your clients and for you if under certain circumstances. All I'm suggesting is you're going to want to sit down, think about these things with your clients, because we can put these plans in any time before the end of this year. As long as they're signed and in place on or before December 31st, you can take the deduction all the way back to January 1 and fund for the full year. So they're really quite powerful. Now, let's say that doesn't work, because all these qualified retirement plans have specific rules that they have to abide by. We know that. Vesting, basically for a defined benefit plan, you're stuck with 3-year cliff vesting at the most, or 2 years, they had 20%, 40, 60, 80, and 100 after 6. And maybe that doesn't work for your employees. Maybe you want something that's more of a retention, more of a vehicle to motivate certain behavior and to make sure that your key people don't stick around, or that stick around and don't leave you or don't compete. Then that's when we turn to look at non-qualified plans. And no discussion of how to build up the nest egg would be complete without at least mentioning that there are a whole series of things you can do in the non-qualified area to help save money this year, to defer compensation. We're all familiar with non-qualified deferred compensation, whereby you forego receiving pay or a bonus or something like that. It stays with the company, and you take it sometime down the line. Those plans are subject to 409A, which is a terrible code section that we live with every day, which impose a number of rules that remove flexibility as to exactly how and when you take them. In other words, most of those decisions need to be made up front. But non-qualified deferred comp works quite well for many companies and for many people, because you're able to defer compensation and not earn it this year for other than Social Security, Medicare purposes, and take it in a year after you retire or sometime down the road when you expect your tax rates to be lower. The obvious problem with non-qualified deferred compensation, and it could just be standard deferring my money versus some type of a supplemental retirement or a SERP bonus. The problem with that obviously is the company can't take the deduction until the employee takes the inclusion. Unlike the qualified plan where you get the deduction, even before you actually fund it. Here, you don't get the deduction until it's paid. So you have to look at the circumstances because you have a lot of pass-through entities like LLCs and S-corps where they're effectively being taxed at the owner's rate of taxation, which is higher in many cases than the executive that you're deferring for. So it doesn't make a tremendous amount of sense to build this big, robust, defined contribution, deferred compensation plan, and then have the owner paying taxes at their rate. So you have to take those kinds of things into consideration. But again, if you get up to that level and you want to do more, or the qualified plan area doesn't work for you because of all the limitations and other concerns, then you certainly then will look at deferred compensation or supplemental retirement plans for your employees. And again, those aren't necessarily funded. So from a tax standpoint, they're not. Those are dollars of the company, subject to the general creditors of the company. If the company goes bust, you're just a creditor like anyone else. But most companies do sock the money away in investments. They'll use what's called a rabbi trust. They'll use mutual funds or some other funding vehicle, and they'll have the money invested in a way so that when that obligation ultimately comes due, or maybe they'll use some type of insurance contract, but whatever, when the obligation then comes due, they'll have a pile of money they're able to pay for it. So it's still a good funding vehicle, for, particularly for investment brokers. So those are the techniques that we're seeing. I expect that you're going to be sitting down in the next 2 months with a lot of clients who are going to be looking at, or for yourself, looking at ways I can defer compensation that I would pay this year at what we know are high rates to at least next year, if not sometime down the road where we expect it might not be as high. So those are the techniques, Roger.
Right, thanks, John.
Okay.
I think I read in the Trump plan that with the corporate tax rate reduction, they would also extend that equivalent rate reduction to any pass-through entity, so that the LLCs and the partnerships, S corporations, would have the benefit of the lower business tax rate, so to speak. Well, now that we've accumulated a lot of funds, Mike, what are some of the difficulties faced by participants as they plan for their own retirement, withdrawals prior to death, and what happens when they pass away?
Well, we can talk about some of the difficulties and some of the opportunities. I do want to turn back to John and Tony for a moment, because that was quite a whirlwind through the qualified plan area. I thank you, and I warned them that I was going to hit them with a pop quiz at this point. They already got one answer right, but let's try the other one. 2 questions. The first one was, the answer is $24 trillion, and the answer is...
I think we decided.
The question is,
I think we decided what is the total balance of qualified retirement plans right now.
according to the General Accounting Office, how much money is in qualified retirement plans and IRAs on a tax-deferred basis right now? That's a lot of money.
Yes. Which
Tony's first guess was the national debt. And I it's interesting how they're both kind of in the same order of magnitude, perhaps. So my second answer that you need the question for is $7,270,000.
I was
And
going
in
to go.
fairness to them, they weren't asked this ahead of time.
I was going to go with Roger's IRA balance.
Mine is huge, but not big, that big.
It could be that answer, because the answer is the same General Accounting Office study, I think it was in 2013. They looked at a number of questions, and one of them was, if somebody had maxed out their defined contribution plan contributions between 1980 and 2011, and they were invested in some type of a balanced S&P fixed income account, what would be in the account at that date? And it was
Wow.
$7,270,000.
The magic
Which-
of compounding.
Yeah, exactly.
With the magic of compounding. Now, they also added that a very, very slight percentage of participants annually max out their contributions, and an even smaller group would ever have done that every year during that period. So don't feel bad if your account isn't there. Or maybe you would feel bad, because that'd be a nice account to have. But my point is, there is a lot of wealth building opportunity there, and there are a lot of dollars out there that the government's going to count on collecting taxes on here over the next decade or so. It's a reality in the budget process at all times, as we'll talk about some more. So there's a lot of money out there that's going to come out. And this is a kind of a watershed year, or certainly couple of years. And what I'm thinking about there is staying at this 30,000 foot level. You know, 1946 by some accounts is the beginning of the baby boom generation, maybe earlier or later, but say it was 1946. Well, all those people are turning 70 this year. So, and that's supposedly about 3.5 million people turning 70 this year. And for the next, however you measure the baby boom generation, through 1965 or so that would be, you know, almost the next 15, 20 years, 3 to 4 million people a year are going to turn 70. So that $24 trillion is starting to come out, and just because of the demographic. Now, we all know the baby boom, you know, has aged, and we heard 5 years ago they were turning 65. Well, they're turning 70, and of course, to take it back to the qualified plan and the required distribution topic, all this money is starting to come out. And I'm sure those of you who are thinking about it as participants, and those of you who are advising participants, are having these conversations. So I do want to talk in a minute about the required distribution rules and some of the implications and planning that we do around that. A couple of other comments about why it's a watershed year. The woman who wrote the minimum required distribution regulations in 1987, bonus for anybody who can name this woman. She also wrote the revision of the required distribution regulations, which is 409A. 401A9 of the code for your required distributions. She also wrote the revision in 2002, which dramatically changed the rules, which we'll review in a moment.
I'm guessing Evelyn Paycheck.
No, her name is Marjorie Hoffman. Marjorie Hoffman, and I just noticed in the, she left the IRS, went on the Joint Committee of Taxation, and there's a bill pending right now that there's some talk about it coming out of the lame duck session in the next few weeks, which would dramatically change all the planning that we're going to talk about and have, and namely the stretch IRAs. You've probably all heard that there have been proposals to curb the stretch IRA opportunity. And Marjorie Hoffman has been on the Joint Committee of Taxation. She was involved in writing up the study for that, and they just announced that she's retiring. So the woman who gave us the retirement, distribution rules is retiring from the Joint Committee on Taxation. Final watershed event, Natalie Choate, a name many of you know because she's the woman who has made a career since Marjorie Hoffman wrote these regulations, a career advising people on how to plan for distributions from retirement plans and estate planning with retirement plans. Natalie Choate has been the national guru. Well, she turns 70 and a half this year and has written a couple of amusing pieces about how difficult it can be to figure out your required distributions. And this from the woman who has written literally the book on how to do so. So all of those things are coming together, and I think as planners, we're certainly seeing it. You know, the phone is ringing, the emails are coming, lots of questions about, now that we've accumulated this balance, how do we deal with the planning going forward? One of the bills, provisions of this bill that's pending, by the way, in the Finance Committee, and has bipartisan support. One of them talks about allowing continuing contributions post 70 and a half, recognizing that people are living longer. So I'm going to talk about the distributions, but there might be even changes that would allow John and Tony to continue to get people funding into even IRA contributions past 70 and a half. Not law yet, but it might be coming. Okay, so to transition from all this accumulation into the retirement mode, whether that is happening because you're leaving employment, you're switching jobs, you're actually reaching your retirement age, there's some decisions that get made, obviously, around at that time. And by and large, I think the trend has been to increase the number of options that are available, to add some flexibility. All this is, I think, pressure from the growing number of people who are in this situation, and Congress and the IRS has responded by being a bit more flexible in the past, and I'll mention that. But the first thing you do, of course, is read the plan. What does the plan say? You're considering retirement, you're leaving, you've got a retirement benefit. We can talk all day about what the law requires and what the tax code says. It may not mean anything if you're in a plan that says when you turn 65 and terminate employment, here's your lump sum. Good luck to you. It's not the end of the story, but the point is that the plan will dictate. Maybe the plan provides for an election of installment payments. Maybe it provides for annuity forms of benefit. Maybe it does have a lump sum. So look at your plan and see what it offers, and then factor that into your planning. I saw an article recently called "Stay Over versus Rollover." Some people are able to look at retiring and keeping their funds in the plan, staying over in the plan, taking advantage of the professional advice that the plan has. If there's a distribution option, to let them keep that in place and move into retirement. That might be an attractive, easy answer. In many cases, of course, what is going to happen is there will be a distribution and a rollover into an IRA. Now, the topic of rollovers is a large one, and I'm just going to glance past some of these. But it obviously is a critical transaction that you want to get right. If you're taking 20, 30 years of savings out in a single distribution that you haven't paid tax on yet, you don't want to pay tax on it at that time. You want to safely transition that into an individual retirement account, roll over IRA, keep your tax deferral going. I'm only stating the obvious, but for many years, that was the line that the IRS would not cross. Namely, if you missed your 60-day rollover of a qualified distribution, there was no mercy. They read the Internal Revenue Code as requiring that to be a fully taxable event because you failed to have a qualified rollover. There were a lot of unfortunate outcomes under that rule, but the IRS was unwilling to move on that. Well, it's several years ago now, many years ago now, there was some relief offered in the code. Congress changed the code to say if it were truly, against good conscience and impose a hardship, it gave the IRS the ability to grant some relief on the 60-day rollover, people who missed that. And those of you who follow the private letter rulings know that that opened the floodgates, and for every year since then, I would say by far the largest number of private letter rulings coming out of the pension department at the IRS has to do with blown rollovers and are they going to allow relief. And the IRS has been generally fairly lenient on that, unless you were trying to game things a little bit and you just missed. You took the money out and you invested it and it didn't come back at the right time. But there were a number of, if it wasn't your fault, if it was an event outside of your control, arguably, then the IRS has been fairly lenient. And we've gotten a couple of those for clients when they missed their 60-day rollover period. But that required you to go get a PLR, and there's a cost to that. Now, the IRS initially sent out a schedule that said, we'll reduce the cost for that kind of a PLR, and depending on the size of the rollover that got blown, you might even get it, the user fee might be a $500 fee or a $2,000 or $3,000 fee to get your private letter ruling allowing you to complete the rollover. So that was a bit more reasonable. Last December 15, they took that away and they put the fee back to the standard private letter ruling fee of $10,000. So that if you wanted relief from the 60-day rollover rule, it cost you $10,000. By the way, it takes about a year. You ought to plan on a year anyway. We were a little quicker on a couple. And then you got to pay counsel to process that for you. So very expensive, time-consuming process. Happily, what happened was they increased the fee back to $10,000, but then we got Revenue Procedure 2016-47, which is a self-certifying rollover cure. So I'm dwelling on this because it's fairly new and it can be significant. But if you have a blown rollover, you don't even have to go to the IRS and get a PLR in order to have a good rollover if you meet the criteria set forth in that RevProc. So I recommend 2016-47 for any problems with the 60-day rollover rule. There is no cost. You write a letter, you provide it to the administrator, and you put it in your tax file and you're self-certifying that one of the 11 reasons that they give is the reason why you missed the rollover. Included among those, by the way, are the one that we had, which was a distribution was deposited into an account that the taxpayer thought was tax deferred, but was not. Number one, obviously the error was committed by a financial institution that was receiving the contribution. So they are the most typical commonplace type errors, and they're covered under that procedure, including incarceration, by the way. So, and there have been some favorable rulings in that regard. All right, that's a lot on rollovers, but it's really what happens so often at the time of retirement or transition, and you want to make sure it's right. And I think the government has come around to, help people avoid really undesirable outcomes there. So what happens when you're 70 and a half? This has been the law for a long time, and you can probably all recite this by heart, but just to go through it quickly, that is your first required distribution year, the year in which you turn age 70 and a half. You have to make that first distribution by April 1st of the year following the year in which you attained age 70 and a half, but if you do wait to the first quarter of the following year, then you need to take the first year's and the second year's required distribution in year number 2. So do your tax planning and decide, does that push you into a higher bracket? Would it be more efficient to spread it out over 2 years? That's been the case for a long time. That's the rule for IRAs. That's the rule for qualified plans, unless you are a 5% owner of the company, the sponsor of the qualified plan. If you're a 5% owner, if you're not a 5% owner of that plan and you continue to work at the employer sponsor, you don't have to start your required distributions until you actually retire. If you are a 5% owner, then you still have to start at 70 and a half from your qualified plan, whether you are retired or not. Did I get the qualified plan rule right on that?
But that doesn't apply to the IRA, obviously.
It doesn't apply to an IRA. If you're in an IRA, whether you're working or not, you need to start taking your distributions. And you can make that decision about first year, second year. Why is it important to get your required distribution? And each year of your retirement, take that required distribution, because if you miss it, it's a 50% penalty measured by the amount that you didn't take. So if your required distribution is $50,000 and you didn't get it done that year, the penalty is $25,000. We've seen some big penalties in the past, and in the distant past, I've seen some big ones paid. I remember one $75,000, and the taxpayer wrote, $37,500 to the Internal Revenue Service and then ask for it back. The good news on this is you can ask for a waiver of that penalty for a reasonable cause if you fail to take your required distribution. We've been successful in getting that done in many cases, and it's no longer required that you pay the tax in order to ask for the waiver. So you don't have to pay the tax and ask for it back. You can simply submit a 5329 with your tax return, explain the circumstance, explain that you fixed it, and hope that you never hear about it again. And again, the IRS has been pretty understanding in terms of explaining if you can explain a reasonable cause for that miss. So phasing into, now going into sort of the retirement years and year to year, how you look at the stream of income. If you think about all the different sources or types of plans that John and Tony were describing, you might have, and more people do have, qualified retirement money in more than one bucket. It's no, we all know we're not all working for GM for a career of 35 years and retiring with one big pension anymore. We've got pension plans and IRAs from former employers, and there's portability, and we've moved things around, and people have a lot of different sources. You might have government funds, you might have, of course, you likely have Social Security, you've got IRAs, you've got qualified plans, maybe defined contribution and defined benefit. Well, it's a lot to look at and manage and make sure, that you are getting your required distribution once you're 70 and a half and retiring from each of those sources. Now, if you have multiple IRAs, you measure the required distribution from each IRA, but then you can aggregate and take it from one or the other of that group of IRAs. You cannot do the same with qualified pensions or qualified plans of any kind. Each of those you have to get the required distribution from each of those plans, regardless what you do with your IRA. I've seen people confuse that rule and get tangled up, but it's IRAs you can aggregate and take the required distribution from, not qualified plans. How do you measure it? Do we go to the Uniform Life Table while you're alive? Unless you're married to a spouse who she or he is your beneficiary and they're more than 10 years younger than you, everybody's on the uniform table. You go get your life expectancy factor and divide that into your prior year's balance. The basic math really hasn't changed, but what I find interesting about that formula, it's not intuitive, and when people do understand it, it makes them nervous. And I'll bet you've seen this too, because the vision people have in mind for the nest egg is, let's build up this fund of dollars, and then I'll just clip my coupons for the rest of my life, or I'll live off the interest, but I'll have this nest egg, this capital there generating my income. And what happens when you understand the required distributions, of course, is it's a depleting asset. The math forces that asset out of the account over your expected life expectancy. Now, you don't have to spend it, but it's still going down. That account that you built up and watched build and you want to live forever on that account, it starts to go down. It's like an existential moment. It's going to run out, and that is the idea. When it runs out, you're dead. And that's the theory of it. And so it makes people a little uncomfortable. Now, you don't have to spend it, obviously, but it's going to be taxed, and so you're losing the tax-deferred opportunity. Factor that into all the planning. Maybe you couple it with the non-qualified plan distribution that's coming you look at your Social Security, your non-qualified plan, maybe you do have a pension that's fixed and you've got that coming in. So you can rely on just the minimum required for as long as possible and use other after-tax money, if you will, to live off and maximize your tax deferral. A lot of variables in the lifetime planning. The most interesting newer one, to me anyway, are the so-called QLACs, the Qualified Longevity Annuities. I don't know if anybody's seen one of those yet or done one. It's been around just a couple of years. And it's a modest amount, so I don't think it's made a big change in the industry yet, but if it's an idea that gets momentum, it might. And a qualified longevity annuity is really Congress's recognition, and it might also have to do with the insurance lobby, but Congress recognized that people were nervous about running out of money and watching their accounts go down in the qualified plans. Because once you're at your required beginning date, 70 and a half, and you start that math formula, it's coming out and you're going to run out. Well, a qualified longevity annuity is an exception to that, where you don't have to take a required distribution out of any amount that you invest in a qualified longevity annuity, which can start at a later date. So it won't be 70 and a half. You can say, I want that money in 75 or 80 or 85. Can't go past 85. But you can purchase one of these QLACs up to $125,000, which is not going to change, life for people with mega accounts. But up to $125,000 or 25% of your account, plus in one of these deferred annuities, so that you can say, park that money out when I'm 85, and then plan and take it out of my required distribution formula, and then try to spend all your money up to 85 out of your qualified plan, knowing that you've got this fixed annuity coming for you when you're 85. Interesting idea, been around just a couple of years, and if it grows as the population lives longer, I suspect we are going to see more of that. Another technique that we see people thinking about, of course, and Tony talked about this, if you're uncomfortable about the idea of this depleting asset, taking your 401k or your IRA during retirement and having the money deplete and run out, is the Roth option, to do a Roth conversion. Now, it takes a brave soul to write that big check, but if you've got a converted Roth IRA, you don't have any required distributions during life from the Roth IRA. So if you want to preserve dollars, if you can afford to live off these other assets, a pension, a non-qualified, some other source, and you want to take that bucket of your rollover money and delay the depletion of that, you could think about a Roth IRA. Of course, you're going to deplete it quickly with paying the tax, or if you really want to maximize the benefit, pay the tax with other money, get that Roth IRA, qualify and move forward, and even pass it to the next generation. They will have to take their required distributions, but you don't have to during life. Put that into the mix, and that can give you some more longevity. Although, to Tony's point earlier, maybe you don't do that this year. Maybe you wait and see if the tax rates go down in the new administration, and there might be some good years to do a Roth conversion before later increases. Because if your effective tax rate is going to be later or higher later when you make your withdrawals, then the economics probably don't work on that, on the conversion. Turning to some estate planning concerns.
They present, the retirement benefits present some difficulty in terms of trying to extend the life of the IRA payout or qualified plan payout when when the client is faced with wanting things to be in trust, especially for children or a spouse. And so we've got a number of options. Trustee IRAs are popular. because you can have the IRA in an account at death that will continue. We can also create trusts as part of the estate plan that will extend. Spousal rollovers are our default option, but if there is a concern about remarriage, it's a second marriage, it's any number of issues where you might want to protect that, then we can use a Q-tippable or a marital deduction trust. Charities are also an option. We had a question, how does that work at death? Is that really advantageous? And it is, even for people who aren't in an estate taxable range, can direct the qualified plan benefits to a charity. And so you take what would be income taxable to beneficiaries, transfer it to a charity instead, and there's no income tax there. That preserves non-taxable, already taxed assets that can be of greater benefit to the children than receiving the IRA, having to pay income tax as it goes along.
Let me jump in on that example, because it makes another point, which is we see issues with beneficiary designations all the time. And if there's one kind of practical takeaway, and you already know it, but here's the helpful reminder, look at the beneficiary designations. Help your clients look at beneficiary designations and look at your own. The amount of time that we end up spending for clients trying to fix problem beneficiary designations is maybe more time than we help them design the plans to save all the money. They can create real problems. And we can all list scenarios. Former spouses or the death benefits beneficiary. Got one of those right now. And so what does the administrator do? Well, what does the state law require? Is there an automatic revocation? What does the plan say? Does the plan say there's an automatic revocation? Is there a default beneficiary? Is the default the estate? All questions you need to sort out because the beneficiary designation didn't get updated, and there might be some very unhappy children or other family members because of that, and there are many. But on the charity, that's another really good example, because charity, and we have a question, what are the benefits about giving retirement money to charity at death? That can actually happen during life too with qualified charitable distributions, which we now have got permanently over 70.5, not more than 100,000 a year, direct to the charity. But there's a lot of nice opportunity there. But if you've got the idea of using your retirement money to fund some of your charitable intentions, whether at life or at death, there's some real great leverage. Use the government's tax dollars to give them to charity and maximize your other assets for family. That all works great. Charitable, maybe an income tax deduction, maybe an estate tax deduction if that's going to matter going forward. A lot of good features, and the easiest way to do that is write the charity's name on the beneficiary designation. Boom. You've got all the results, the tax results you're looking for, and maybe the gift you're looking for. Of course, that's very limited and constrained, and what if you change your mind, and what if you have other contingencies? So inevitably, the designation might say, we'll pay it to the trust, and the trust will provide for charity. Not out of the question, and we certainly see it, but let me give you a quick litany of issues that creates, as opposed to the direct charitable beneficiary. If I say, I want to name a local hospital foundation, dollars in this account go right there at death. Everybody's happy, good tax results. If I say, well, it needs to go to a trust first, and I've got, first my spouse and then my children and then the balance to charity, structure it as you will. Now you've got questions about, is that a see-through trust for stretch IRA purposes? Not if you have a charity in there, and not unless you can remove the charity before September 30, the year following death. You've lost your see-through status to stretch payments to the other beneficiaries because the charity's in there. what if the account gets paid to the trust and then to the charity? Can the trust deduct that as a charitable deduction? You got a whole set of different deduction rules for a charity that you need to qualify for, or the trust might end up paying the income tax that you're trying to get to charity. The separate share rule, another favorite of ours, our other beneficiary is going to pay some tax on that. So you create a lot of issues if it goes to trust. It can be done, and sometimes there's an overwhelming reason why you want these dollars going through a trust, generally for family priorities, but be aware that it does create some other issues. I said I wanted to get back to the lame duck. May I, for 30 seconds? There is a bill. It's got bipartisan support in the Finance Committee. Both Senators Wyden and Hatch have sponsored it and endorsed it. And it takes the stretch away on IRAs, makes the 5-year rule the standard default rule. So instead of naming your child who might have 30 years to stretch the IRA, it would have to come out by the end of 5 years. There are exceptions for older beneficiaries, sick beneficiaries, spouses, but the default rule for non-spouse beneficiaries and children and grandchildren would be 5 years. That would be a huge change. They have another twist in there that says it's only dollars over $450,000 that would be subject to the 5-year rule. So up to 450, you could continue to stretch. That would make it really complicated, but create some continuing opportunity.
All right. Well, thank you all for coming. We promised to end by 1. We're a little over. Here in Cleveland, we'll stick around to answer questions. We continue to follow the latest developments, especially as we transition to a new administration and unified with Congress and Senate together in the same party. Tune into our website for a replay if you want. It'll be on in the next week or so, maybe sooner. We look forward to hearing your thoughts on the program today, and we really thank you for being here. We're adjourned.
I will get this back to you.
It was washed before, so I'll just put it in my pocket and watch.